All right, example problems from chapter 12. This chapter is looking at the accounting for partnerships, and we're really kind of focusing in on the equity portion of a partnership. So this first example is going to look at how we record the forming of a partnership, right? So if Mike Durr and Mark Finger come together to form a partnership, and Durr contributes these following items, and these are all listed at their market value. We are going to prepare the partnership's journal entry to record Durr's investment. So the partnership is receiving cash, supplies, equipment, land, accounts payable, and notes payable. This is the value of these assets on the date that the partnership was formed, and these were the amount of liabilities. So when we're recording this, we are recording the assets acquired by the business, debiting all the assets for their fair value or their market value, and record the liabilities for the amounts owed on that date. The partnership is essentially contributing, Mike Durr is essentially investing into this partnership. So we are going to increase Durr's capital account by the value of the investment. And the value of the investment is going to be the difference between the assets, which in total are, we'll add them up here. In total, the value of those assets are $17,000. But the partnership is also taking on these liabilities that Durr brought in, and so the partnership's going to be paying these liabilities, which will offset the value of the assets brought in. So I'm subtracting those liabilities from the value of the assets, which means the amount that Durr is investing. The value of Durr's investment into the partnership is $9,400. So that is the amount that we will record into the capital account. Let's continue looking at how we account for the equity transactions in a partnership. And Watts and Lyon are forming a partnership. Watts invests $42,000 and Lyon invests $63,000. Now when a partnership is formed, there is a partnership agreement. And in that agreement, which is a legal binding document, the partners have agreed that Watts will work 1/3 of the total time devoted to the partnership, and Lyon's going to be working 2/3. So they have discussed further that the following alternative plans for sharing income and loss. So they're trying to decide when they get to the end of each accounting period, when the revenues and expenses are closed into income summary, and then that income is then transferred into the owner's capital account. They're trying to determine how they're going to break up the amount of that income into the two owners' capital accounts. And so the different ideas they've come up with is to have a ratio of the income being distributed based on their initial capital investments. Or they can allocate income in proportion to the time that they devote to the business. Or they can allocate an allowance of $72,000 to Lyon in salary each year, and the remaining balance in accordance with the ratio of their initial capital investments. So in other words, they will pay the $72,000 to Lyon, and any remaining income will be allocated based off of the ratio of their capital investments. Or they can grant a salary of $72,000 to Lyon, then grant each owner 10% on their initial capital investments, and any remaining income would be shared equally. The partners are expecting the business to perform as follows. Year one, they expect income of a loss of $36,000 in year one. In year two, a net income of $90,000, and in year three, a $150,000 net income. Wow, it's a lot of information in there. But what we're going to do is we are going to prepare 3 tables with the following column headings, and we are going to complete the tables, one for each of the 3 years, by showing how partnership income would be allocated under each of those 4 plans. All right, so we're going to be setting up a table here, and you're going to have a column for which plan the calculations from that plan, and how much goes to Watts and how much goes to Lyon. So the first thing we're going to do is we're going to start looking at these plans and determine how income would be allocated. So Plan A and Plan C also includes some of this as well. They are allocating income based off the ratio of their initial capital investments. All right, initial capital investment from Watts was 42 and Lyon was 63. So the total invested between the two, 42 and 63, means in total they both invested 105. Watts' ratio or Watts' proportion of the total investment is 42. So if I divide 42,000 by the 105, Watts is contributing 40% of the initial capital investment, and Lyon is investing 63,000 out of the 105, or 60%. Okay, so that's the percentage of their initial ratio, or excuse me, their initial capital contribution ratios. Okay, 60% from Lyon and 40% from Watts. All right, so we know how they will allocate income when we're using the ratio of capital investments. Now let's look at the proportion of time devoted to the business. All right, well, they told us that Watts will be devoting 1/3 of the time and Lyon 2/3. So for Plan B, that's how we're going to allocate income based off their fractions of total time. Plan C, we're going to give a salary allowance to Lyon and any remaining income based off of their initial capital investment ratio. So salary allowance will be 72,000 to Lyon, and then any remaining income will be 40% to Watts, 60% to Lyon. And finally in D, we are going to be allocating salary of 72 to Lyon, 10% interest to each owner based off of their initial investment, and any remaining shared equally. So we already know that the 72,000 allowance goes to Lyon. Then the interest allowances would be based off of 10% of their initial investment. Watts is investing 42,000 and Lyon is investing 63,000. Okay. So allocating that now, let's start with the first year where they have a $36,000 loss. Under Plan A, we're allocating it based off of their percentages. So this loss of 36,000, 40% will be allocated to Watts, 60% to Lyon. And because it's a loss, it is going to decrease those owner capital accounts. In B, we're going to allocate the loss based off the proportion devoted to the business. 1/3 of the loss goes to Watts, 2/3 to Lyon. If they follow Plan C, we're going to allocate 72,000 salary to Lyon and the remaining balance to their initial capital investments. So this gets a little bit more complicated because we initially are going to give $72,000 over here to Lyon. After we allocate that $72,000, we need to also allocate a loss. So we're going to add that $36,000 loss to the amount of salary. Okay? So 40% of that remainder is going to go to Watts and 60% will go to Lyon. So look what we did in total. We initially increased Lyon 72,000, but then we decreased it by 64,800. Okay. And Watts is going to have a bigger decrease to the capital account than what the loss actually was because we need to somehow account for Lyon's salary too. Okay. So overall, Lyon actually will have an increase to Lyon's capital account, but Watts is going to end up with an overall negative capital account, unfortunately, because the business took a loss. but the business still had to pay that salary, right? Because it's in the agreement, it's required. Okay, it's contracted. Finally, if we do the salary allowance plus 10% interest, $72,000 we're going to allocate to Lion for the salary. Then we're going to allocate 10% interest, $4,200 to Watts, $6,300 to Lion. But now we have the loss plus these other amounts that we allocated that we need to decrease the capital accounts by. So I'm going to add those together, and I'm going to allocate out that $118,500 equally amongst the two, okay, because we share any remainder equally. Okay. So ultimately, Lion is looking a little bit better off than Watts is with this agreement. So looking at this overall, if I were Watts, I would lean towards wanting to go with agreement B, okay, because that's going to result in the lowest capital deficit. But now let's do the exact same thing, but let's allocate a $90,000 net income. So using all this same information, we're going to allocate each of these plans. Okay. For year 2, we're going to multiply by their initial capital investment ratios, allocating $90,000 of income. 36 to Watts, 54 to Lion. In B, we're going to allocate based on proportion time devoted to the business. 1/3 will go to Watts, 2/3 will go to Lion. In C, we are going to allocate an allowance to Lion and any remaining balance in ratio of their initial capital investments. So we have a $90,000 income. 72 of it will go to Lion, which will leave, of the $90,000 income, $72,000 is allocated to Lion. It will leave $18,000 to go to the remainder will go 40% and 60%. So 40% of that 18 will go to Watts, and 60% of that 18 will go to Lion. Okay, so allocating the total $90,000, $7,200 to Watts, $82,800 to Lion. If we do the final option and allocate $72,000 salary to Lion, 10% interest, that will leave, of the $90,000 income, $72,000 went to Lion for a salary, another $4,200 in interest to, sorry, I lost my number here, $90,000 less $72,000 to Lion, minus $4,200 in interest to Watts, minus $6,300 in interest to Lion. It's going to leave $7,500 in income to allocate. The remainder will go 50% to each. So 50% will go to Lion and 50% to Watts. Okay. So looking at this scenario, Watts is probably thinking, heck, let's go with this first option because that's going to give me the biggest allocation. All right, finally, what if the company had a $150,000 net income? Plan A, 40%, 60% split. 60 to Watts, 90 to Lion. Plan B, based off of the time devoted, 1/3 will go to Watts, 2/3 to Lion. In C, we allocate $72,000 of the income to Lion, and any remainder is split based off of their initial capital ratio. So of the $150,000 income, $72,000 will go to Lion for salary, leaving $78,000 in income. 40% of that will go to Watts, and the other 60% will go to Lion. In D, salary allowance is $72,000 to Lion, plus interest allowances to the two partners. of the $150,000 income, $72,000 in salary to Lion, leaves $78,000 in income. $4,200 will go to Watts for the interest, and $6,300 will go to Lion in interest, which leaves $67,500 in income to allocate. 50% of that will go to Watts, 50% will go to Lion. We have now allocated the total $150 based off of salary, interest, and an even split. All right, taking a look at this one, gosh, it looks like Watts is still better off with the 40-60 split. Okay. All right, let's look at the final area of a partnership. We've looked at the partnership formation. We looked at an example of allocating income in a partnership. Now let's talk about what happens when a partner withdraws from the partnership. Okay, so if Mayor, Benson, and Lau are partners and they share income and loss, this is based off their partnership agreement, they have agreed a 3-to-5 ratio. Mayor gets 30% of income, Benson gets 20%, and Lau gets 50%. The partnership's capital balances as of this date are Mayor $168,000, Benson $138,000, and Lau $294,000. Benson has decided to withdraw from the partnership. So we're going to prepare journal entries to record Benson's withdrawal under some separate assumptions. In the first assumption, Benson is just going to sell her interest to North for $160,000. North is approved as a partner. So Mayor and Lau have already agreed that, yes, Benson, you're leaving the partnership. We will welcome North as our new partner. So that $160,000 that Benson is paying, that North is paying Benson, that is not the partnership paying North. That is Benson taking her own personal cash out of her personal bank account and paying North. All of that cash changing hands has nothing to do with the business's cash. What will happen in the business is that Benson's capital account of $138,000 will become North's capital account. So in the general ledger, the only thing we need to do is transfer Benson's capital and put it into North's capital account. So decrease Benson's capital with a debit, increase North's capital with a credit. In the second scenario, instead, let's assume Benson gives her interest to a son-in-law, Schmidt, and Schmidt is approved as a partner. Again, the only transaction occurring within the partnership is that there's a new partner replacing Benson. So the only thing we need to do is transfer Benson's capital from Benson into Schmidt's capital. So again, we are going to decrease Benson's capital with a debit and increase Schmidt's capital account with a credit. In the third scenario, Benson is paid $138,000 in partnership cash for her equity. All right, so here the partnership is essentially buying that partner out. The partnership's cash is being used to pay off Benson. Cash will go down in the partnership, so we will credit cash the $138,000. And cash went down because Benson's capital is now gone. Essentially, Benson has withdrawn the value of the company, the value of her equity account, withdrew it out of the business in the form of cash. Right? So overall, the partnership's cash went down. Notice that in scenario A, this was North's personal cash going to Benson, right? So it had nothing to do with the partnership's cash. Okay, that's the difference between A and C. Finally, in D, Benson is paid $214,000 in partnership cash for her equity. Okay, let's stop and think about what's happening here. Benson's equity is only worth $138,000, but the other partners were so happy to get rid of Benson, or maybe the partners just thought Benson was a fabulous partner and deserves more than her equity of $138,000. So the other partners agreed to take $214,000 in cash out of the partnership. So cash is going to go down $214,000. All right, let's think about what's happening now. Benson's equity is going away. So we're going to decrease Benson's capital because no longer a partner. All that equity is now out of the business. $214,000 in cash was used to pay off the equity of $138,000, which means there is a $76,000, essentially it's a bonus. A bonus was paid to the departing partner. The other partners agreed to pay that bonus. So what that's doing is they have agreed to take some of their equity and give it to Benson. So what's happening is the cash of $214,000 coming out of the partnership is essentially a withdrawal of the other two partners, their capital amounts. So we're going to split that $76,000 by the existing partners' portion of their ratio. So when Benson pulled out, that 2 out of the ratio kind of goes away. So it basically leaves 3/5 or 3/8, right? Or a total of 8. So we're going to split that $76,000, 3/8 to Mayor and 5/8 to Lau. So the $76,000 times 3 divided by 8, 28.5 of that bonus is going to come out of Mayor's capital account, and the other 5/8 of that 72,000 bonus, actually sorry, it was what, 76,000 bonus, 214, lost that number in my head, sorry, yeah, 76,000 times 5 divided by 8, 47.5 will go to Lau, or come out of Lau's capital account. Okay, so overall the Benson capital account is now gone because that partner does not exist in the partnership anymore, and the other two partners' capital accounts decreased by their share of the bonus that they gave to the departing partner. Okay. All right, let's look at one more here. Let's assume that Benson does not retire from the partnership as described in the part 1. Instead, Rhodes is admitted to the partnership on February 1st with a 25% equity. We are going to prepare journal entries to record Rhodes' entry into the partnership under separate assumptions. Okay. Let's assume that Rhodes invests $200,000. Okay. The business is getting cash of $200,000. And so Rhodes' capital account is going to need to be increased by 25% of equity. So we need to figure out what equity is in order to determine what that 25% will be. So as the partners coming in, equity is $168,000 from Mayor, $138,000 from Benson, and $294,000 from Lau, plus the $200,000 that Rhodes is now investing. So as this new partner comes in, total equity should be $800,000. 25% of that equity will go to that new partner, or $200,000. So because the partner is investing $200,000, which is equal to their share, 25% of capital, it's a pretty simple recording. There is no bonus that the partners are giving to the new partner. But if this new partner Rhodes only invests $145,000, the business's cash increases $145,000. The equity will be the $168,000 from Mayor, $138,000 from Benson, and $294,000 from Lau, plus the $145,000 invested by Rhodes. Total equity is $745,000. 25% of that is 186,250. That is the amount that will be recorded into Rhodes capital account, 186,250. The partnership is receiving cash of 145 for an equity value of 186,250. So let me subtract the difference between those two. Essentially, there is a $41,250 bonus that the new partner is receiving. Because the existing partners think this new partner is so valuable, they're willing to grant a 25% equity for only a $145,000 investment. So what we need to do with this $41,250 is split it across the existing partners based off of their existing ratio. So 30% of that $41,250 will go to Mayor. So 41,250 times 3 divided by 10. 12,375 will come out of Mayor's capital account. 20% will come out of Benson's, and Lau will contribute 50% of that bonus. So really what's happening here is we have moved some of the other owner's capital into the new owner's capital account. What if in C, the new partner contributes $262,000 to get a 25% equity? Okay. So again, the business is going to receive cash of $262,000, so we debit cash. To come up with the 25% equity, we are going to add the existing equity to the new capital equity invested, $262,000. Total equity of $862,000. 25% of that will go to the new owner, the new partner. So $215,500 will go into Rhodes capital account. What we have is a $262,000 investment in cash for a partnership equity of $215,500. There is a $46,000 $500 bonus going to the old partners, right? The opposite, because this partner is investing more than their equity. So essentially the new partner saying, I value being a part of this partnership so much that I am going to contribute more than the equity I'm going to receive. So in that case, we are going to add this bonus to the existing partner's equity accounts. So again, we're going to multiply that bonus times their income sharing ratios. 30% to Mayor, 20% to Benson, and 46,500, 50% to Lau. So here the existing old owner's capital accounts increased. Okay. All right, our last problem from this chapter is looking at the liquidation of a partnership. Kendra, Cogley, and Mai share income at a loss, income and loss in a 3-to-1 ratio. Kendra gets 3.6, Cogley 2.6, and Mai 1.6. The partners have decided to liquidate their partnership. On the date of liquidation, this is how the balance sheet appears. We're going to prepare the journal entries for this liquidation. Okay, so essentially the partners have decided we're done doing business, this partnership no longer exists. So the steps in a liquidation are to first convert all of the assets into cash. Okay, then that cash would be used to pay off any liabilities of the business, because creditors are paid first before any assets are distributed to the owners. All right, so first step, we got to sell that inventory, convert it to cash. Okay, so let's assume that the inventory is sold for $600,000. Preparing the journal entry, we would debit cash for $600,000, decrease the inventory for $537,200, and record a gain. We sold the inventory for more than what it was worth. Any gains that are basically incurred on the sale of the assets are recorded as an increase to the value of the owner's capital. It's kind of like an additional profit, right? We made a profit off of selling off our assets. So what we're going to do is we are going to allocate that gain to the owner's capital account based off of their income sharing ratios. So Kendra gets 3/6 of that gain, Cogley gets 2/6, and May gets 1/6. All right, so let's think of what happened. This business started with $180,000 in cash. We just sold the inventory for $600,000, so the cash has now gone up another $600, so the cash of the business is now $780, $800, no other assets. So the second step will now be to pay off the liabilities. So we are going to use some of that cash to pay off the liability accounts payable of $245,500. When that is recorded, the cash will now decrease $245,500, the amount of the liability that was paid off. So now the business is left with $535,300 in cash. The final step will now be to distribute that cash to the owners. The owners are going to be paid this cash based off of their share of equity. Okay? So let's think about what their equity is at the end of this liquidation process. Kendra had equity of $93,000, but then was allocated $31,400 for her share of the gain. So Kendra's capital is $124,400. Kendra will get $124,400 in cash. Cogley's capital went from $212,500, increased $20,933 for share of capital. Cogley's capital will go down to $233,433 as the capital is bought out, and get cash of $233,433. And my had capital of $167,000. It increased $10,467. My's capital is $177,467. Debiting all these capital accounts because the partnership is liquidated. There is no more capital account, and the cash will all be distributed to the partners based off of their share of equity. Let's assume instead when the partnership is liquidated, the inventory is sold for $500,000. All right, so first thing, we're going to sell that inventory. Business is going to receive cash of $500,000, debit cash. Inventory goes down the $537,200, and we sold this inventory at a loss for less than what it was worth. That loss is really kind of decreased in the owner's capital. So we're going to allocate that loss based off of their income sharing agreement. 3/6 to Kendra, 2/6 to Cogley, 1/6 to Mai. So these capital accounts are decreasing to close out that loss. What has happened to cash? Well, the business had cash of $180,000, $8,800. When they sold the inventory, they sold it for $500,000. So the business now has $680,800 in cash. The next step is to pay off the liabilities. So some of that cash is going to be used to pay off the account payable. Debit the liability, credit cash. Cash will go down to $245,500. So cash is now down to $435,300. This cash is going to be paid out to the owners based off of their capital amounts. Kendra's capital had been $93,000, but the loss decreased at $18,600. Kendra will receive $74,400 in cash. Cogley had been $212,500. It was decreased by Cogley's share of the loss of inventory sale, bringing Cogley's down to $201,000. Cogley will get $200,100 worth of the remaining cash. And Mai will get the 167 less the 6,200 or 160,800. After this is recorded, there are no assets, no liabilities, no capital accounts. The business is liquidated. It's done. Finally, what if the inventory is sold for $320 in cash? Debit cash for $320, credit inventory for $537.2, record a loss of $217.2. Got to allocate that loss. Decrease in the owner's capital account based off of their income sharing agreement. 3626 and 16. Now let's think about what happened. Look at Kendra's capital account. It had only been $93,000 before this loss allocation. We just decreased Kendra's capital account $108,600. There is a deficit in Kendra's capital account of $15,600. So unfortunately, Kendra is going to have to contribute $15,600 because the partners with deficits will pay their deficits in cash. So Kendra needs to contribute $15,600 to the business from her personal cash. Essentially what that does is it brings Kendra's capital back up to zero, so it's not a negative amount. So what's happened to the business's cash? There was $180 in cash before selling the inventory. Cash increased $320,000 for selling the inventory. Then cash increased another $15,600 when Kendra contributed. Now that we're done with the sale of the inventory and the owner capital accounts are, any deficits have been dealt with, now we're going to pay off the liabilities. So we're going to debit accounts payable, credit cash. Cash will go down $245,500, bringing cash of the business down to, hold on, I think I made an error somewhere. Let's go back and recalculate that. I think I came up with the wrong amount. Cash had been $180,800. And we added $320 when we sold the inventory, bringing cash up to $508. And then cash went up $15,600 with the contribution from Kendra, bringing cash up to $516.4. And then we paid cash of $245,000. Bringing cash down to $279,900. Okay, so after we paid off the liabilities, the only thing remaining is cash of $279,000. Okay, so that cash is going to be distributed to the owners based off of their capital balances. Remember that Kendra's balance was zero because it had been a deficit and Kendra paid in to get that back up to zero. So this cash is going to be distributed to the two existing partners with capital balances. Cogley had been $212,500, but then we decreased it $72,400 for the deficit. Same thing with it had been $167,000 but decreased $36,200 for the deficit. So the cash is distributed to them based off of their capital balances. Let's make a final assumption. Assume that the partner or this inventory was sold for $250 in cash and the partners with deficits do not pay their deficits. All right, well, let's see what happens here. All right, sold the inventory, took a loss. Loss was $287.2. We are going to distribute that to the owners, decreasing their capital account, closing out that loss. Cogley and essentially are going to contribute some of their capital to help cover Kendra's deficit because Kendra had a balance of $93,000 in capital, but that loss caused Kendra to go into a deficit of $50,600. 93 minus the $143,600. The other owners have said, okay, well, we're just going to have to absorb that loss. So they're going to distribute or kind of deal with that loss based off of their share. Okay. So of the existing, the two capital partners, 2/3 will come from Cogley and 1/3 will come from my. And that is based off of their income sharing. Those two together have a ratio of 2-to-1. So 2/3 to Cogley, 1/3 to my. All right, so what has happened now is we have kind of Kendra's account is back to zero now, kind of absorbed that deficit by the other two owners. So the cash had started at 180, 800. It increased to 50 with the sale of the inventory. So there's 430,800 in cash. No more liabilities, or excuse me, no more inventory. So now we pay off the liabilities, which brings the company's cash down to 185.3. So when we distribute that cash in the last step of the liquidation, there's nothing in there for Kendra. We will distribute that cash to the remaining owners based off of their capital balances, which for Cogley had been 212.5, was decreased by Cogley's share of the loss, and was decreased by Cogley absorbing some of Kendra's deficit. And same thing for my, it had been 167, decreased by my share of the deficit, my share of Kendra's deficit. So Cogley and my's cash distribution will be following their final capital balances. All right, I hope that helps with Chapter 12. All right, I hope that helps with Chapter 12.